Okay, hi. I'm here to talk today about Module B. That is our ethics module. Now, the first thing I want to mention is that really the main thing I want to stress is pages 599 through 609. So those 10 pages on independence are what's going to be really important and what we're going to talk about in class and what's going to be on tests and stuff like that, because this is an audit class. Now, I'm not saying the rest of the chapter is unimportant, and certainly we need to know that, but we have a specific ethics class that discusses accounting ethics in general, and this is an audit class, so I want to really drill down on auditor independence, because that is the super important part of this chapter. So we're going to talk about ethics, and I'm going to really skip a lot of the chapter, maybe just breeze by it, and then really focus on ethics, which is what I want you to study and learn for our quizzes and our exams. Ethics is actually the result of an actual decision process. So you, as an accountant, when you have an ethical issue, will actually stop and go, what are all the facts and circumstances? Who are the stakeholders? What are the rights and obligations to each other? What are alternatives and consequences? Choose that superior consequence. And then I would go ahead and add a step and say, and actually do what's supposed to be done. Where do we get this idea that we need ethics? Well, back in Greek days, they started thinking about how can people be moral? What makes a person moral? What makes them not moral? And it continued on through philosophy, and we've come up with some ideas about ethics. The imperative principle, principle of utilitarianism, and virtue ethics as explained in your books. We're not going to really apply those in our class, but we certainly would use them in ethics class. Immanuel Kant says, therefore you are considering consequences. So a combination of the imperative or duty and utilitarian principles, the greatest good for the greatest number, is to sort of say, what would happen if everyone acted in a certain way? And is that desirable or undesirable? Aristotle, back in Greek days, they discussed virtue ethics, and a person who was a virtuous person was ethical. What they did was ethical. So honesty, openness, integrity, citizenship, all these behaviors go to make you an ethical person because you're virtuous. Now, here's where we get to what's important for this class. There are ethical codes of conduct. All right? And as auditors, we need to understand which codes of conduct we need to apply and when. So you need to understand who makes these rules and codes. All right? So we don't have to do so much ethical decision making or virtue ethics. I mean, there's rules that we follow. These rules come from various sources. One is the SEC, right? So for SEC registrants and for people like you and me who might audit an SEC registrant, we have to understand SEC's rules concerning codes of conduct and what makes an auditor independent or not according to the SEC. PCAOB, they are the organization that oversees auditors. So the SEC oversees their registrants, the companies that issue stocks and bonds that are sold on exchanges. The PCAOB, Public Company Accounting Oversight Board, peekaboo, sometimes people call it, PCAOB issues the rules. As we know, they issue the audit standards, so some of those standards pertain to ethics, and the PCAOB is for auditors of public companies. IFAC is if you are a non-U.S. company, an international company, like say Royal Dutch Shell. The Professional Ethics Executive Committee peak of the AICPA. So a lot of the rules we talk about for accountants come from the AICPA. So anybody who's a CPA has to follow these rules. For auditors, we follow these rules when we audit a not public company. There are state societies of CPAs and state boards. So the state society is sort of like an AICPA at the state level, right? So the Texas State CPA Society is something CPAs join and voluntarily agree to be a member of. The state board, okay, the Texas State Board of Accountancy, they are actually the regulatory part of the state that says these are the actual laws and rules and regulations that accountants must follow. So if you're in Texas, you have to follow the state board's rules, no matter what the state society says or the AICPA says. And certainly if you're dealing with public companies, then you have to follow what the SEC and the PCAOB say. So you've got these sources of rules. And here, from your textbook, is a little table that tells who applies to what. And that is from page 596 of your book. So if you ever have a question about what rules apply to whom, there you go, page 596, that table. All right, so we're going to discuss AICPA Code of Professional Conduct and some distinctions between it and perhaps the SEC Codes of Conduct, but let's start with AICPA. So AICPA applies to everybody who's a CPA, and anytime you're auditing a non-public company, the rules apply. So the Code of Professional Conduct, so this is, Code of Professional Conduct is where auditor ethics comes from, the Code of Professional Conduct. Remember, up till now we've been talking about audit standards. Audit standards are how we do an audit, right? Code of Professional Conduct is the ethical rules that accountants must follow. So not all accountants are auditors. Some accountants do tax season. Some accountants work at companies as accountants. So some are auditors. So this AICPA Code of Professional Conduct are the ethical standards for all accountants. The principles have the ideals. So we have this ideal of objectivity, or this ideal of integrity, right? So principles are these high ideals. Rules are the standards, right? And interpretations are how to interpret the rules. And sometimes somebody actually questions the AICPA or brings a case before the AICPA, and they actually come out with a ruling and say, in this particular case, here is how we rule. So if somebody was like mad at an accountant and they brought them before the AICPA, and this person did this thing, and then they would have a ruling about that. So principles are high ideals, integrity, objectivity, do professional care. Rules are rules, just like we have our audit standards. Kind of works the same way as the audit standards, right? We have our principles, our responsibility principles, our performance principles, and then there's actual standards. Okay. So ethical conduct. So here's your principles. We have responsibilities. We are in the public interest. We have to have integrity, objectivity, do care, and observe the principles depending on the scope and nature of services. So this little part means depending on what you do, you're going to apply different principles. So auditors have to be independent, in fact, in appearance when they do audits. So that's slightly different from somebody who, say, is doing taxes or, say, doing working as an accountant at a company. All right. So the AICPA Code of Professional Conduct consists of principles, then rules, interpretations, ethical rulings, and you just agree to be a member of the AICPA. And here's a breakdown of the different rules. Section 100 talks about independence, right? That's what we're going to focus on. Then, of course, there's general standards, responsibilities, and other responsibilities. We might mention those, but the focus for you for the chapter, section 100 of the AICPA Rules of Conduct, which start on page 599 and go, and all the independent stuff that goes through 609. All right. So, a member in public practice shall be independent in the performance of professional standards as required. Right. So that means when you're your own person, right? An independent person is their own person. They're unbiased. They're objective. As an auditor, we need to evaluate threats to independence, determine if we are independent, determine if we're impaired. So before I do an audit, and we've talked about this a little, I have to think about what about this audit might impair my independence, right? If there is something that impairs my independence, what do I do about it, or do I just need to not do that audit? So what could threaten my independence? Well, there are these threats: familiarity threat, adverse interest threat, undue influence threat, self-review threat, financial self-interest threat, management participation threat, and advocacy threat. So, talking about auditors, right? There's all kinds of accountants, but specifically talking about auditors, you have to be able to issue your opinion free from bias, right? You have to be objective. In order to be objective, you have to be independent. So what could threaten your independence from your client? Say a client asks you to audit them. Great, I have to sit down and think, can I audit them? Am I independent of that client? First of all, familiarity threat. Close or long-standing relationship with a client. That means they're my buddy, they're my friend. Enron is a perfect example of this. David Duncan had audited Enron for many years. His office was actually in Enron's office building. He played golf, he went on vacation with his Enron guys. So it became a threat to his independence. Even though his paycheck didn't come from Enron, he was really buddies with those guys and was going to do what they wanted. Adverse interest. So when you and your client you're supposed to audit are in opposition, right? You have a conflict of interest. Maybe your client is suing you because you did something wrong on your last audit. Well, now, are you going to be unbiased on your next audit? Probably not. That's an adverse interest threat. Undue influence threat. So, like bribes, threats, right? We will fire you if you don't do what we want. Undue influence. Self-review threat. That just means you can't audit your own work. Even if you want to be honest and unbiased, you can't, right? You thought you did it right the first time, right? It's like proofreading your own paper. Financial self-interest threat, this is kind of clear. If a CPA has a financial relationship with a client, that's a problem. Imagine if you own stock in a company, and then you audited that company. Well, what if you found something that would cause the stock price to go down? That would be a problem for you because, well, you own that stock. Management participation threat. Sometimes CPAs or large people within a large CPA firm help with recommendations and running companies, signing checks for companies. Doing the accounting sometimes involves a management type role. So you can actually get to where, as a CPA, you're doing some management functions. And that's always a problem because if you're going to turn around and then audit them, well, it's kind of like self-review threat. You're auditing yourself. And advocacy threat. Sometimes you're going to get on the same side of a client's interest or position. Right? So let's suppose your client hired you to go before the IRS and argue for them in their favor. Right? So you're their advocate. You're on the same side. You're not unbiased anymore. You're in their favor. So you have to be independent so you can be unbiased and objective. And all these things kind of put you either on the client's side or opposite the client, right? So that's not objective, all right? So in order to take care of these threats, AICPA and SEC and PCAOB and these organizations have said, okay, certain people in certain positions and doing certain things are going to automatically make you not independent. So they have rules for people who are covered members. All right. So a covered member is a person to whom the independence rules apply to. All right. So you have to be, in order to be independent, if you're one of these people, the independence rules apply to you. So everybody who's on an engagement is a covered member, right? So if you have a financial interest in a company and you're participating in an engagement, you're covered. That means you have to be independent. You can't do that. In a position to influence the engagement. So if I'm your boss and you're going on the engagement, but I am in a position to influence you, it's the same for me. I can't have a financial self-interest. I can't have self-review threat. I can't have undue influence, take a bribe, right? Even though I'm not really doing the audit, all that independence rule still applies to me. A partner or manager who provides non-attest services to an attest client. So what that means is, non-attest service would be something like does the taxes, does some consulting, does anything, just helps them out in some way that's not auditing, but some other partner in that same accounting firm does the auditing for them, right? So you can imagine in these large firms like in Deloitte or KPMG that you're doing a lot of things for people. So a partner or manager who provides a service can't do it for an audit client. A partner in the office where the engagement partner practices, the firm's benefit plan. So you can imagine the firm like KPMG owns stock in one of their clients. Right? That would not be great. An entity that can be controlled by any person considered a member. So if a CPA owned a part interest in some company that they were auditing and they controlled it. Okay, so when you're on, this applies to audits. Independence applies to audits. All right? Not doing taxes, not working as the controller or CFO at a company. They don't have to be independent. But auditors do, because otherwise people are going to think, they might be biased. Right? So a member, so that means for someone on the engagement, someone who can influence the engagement, a partner for someone who's a client, partner where the engagement partner practices, firm's benefit plan, or somebody who's controlled by an auditor, applies to all of those people. You can't have a direct financial interest. You can't actually own stock. You can't have a material indirect financial interest. You can't have material joint ventures. You can't even really have loans unless they're just kind of like obviously a normal loan, like a regular car loan at a regular rate. Because what happens is, I'm going to go audit this bank and they say, hey, we'll give you, a $500,000 loan at 1% interest. How would you like that? Oh yeah, I'd like that a lot. That's great. So that's kind of almost like a bribe can happen through a loan. But if it's a regular loan, I want to take out a car, it's going to be the regular interest rate, my car is going to be the collateral. That's okay. You can't have a decision-making role at a client. And this happens. You can imagine sometimes CPAs kind of act as substitute managers, signing checks, making decisions about internal controls. So you can't have that. Immediate family members have the same restrictions as the member. So spousal equivalent, so you're living together people, dependents, your children cannot have those interests either. Now so in other words, if you're an auditor for Target Company, you certainly can't own stock in Target, but neither can your husband or wife, significant other, your children. Because it's kind of the same as you having an interest. Hold a position of influence with the client. So your spouse or your child couldn't be the CFO of your client. Could they work in the shop or something? Yes. Just because your spouse works somewhere doesn't mean you can't audit them. But if they work anywhere of influence, then you can't audit them. Close relatives, right? So parents, siblings, non-dependent, so your grown-up adult children can't own or control an audit client or work in an audit-sensitive position. So again, things like controller, CFO, CEO, treasurer, people who, you know, there's going to be a problem on the audit. And even your sister. Could your sister work in the marketing department? Sure. Could she be the CFO? No. Write-up services, this is not auditing, all right? So if you work in accounting, write-up services means you're just sort of taking their data and putting it in proper form. Like, right, you pull down their information from the accounting system and create the cash flow statement, the income statement, the balance sheet. So long as you're not doing anything else, right, for a private company. If you work for a public company, you just basically can't do anything for them but audit them, all right? But yeah, if you work here in Kingsville, let's say, and you're auditing the local bank here in Kingsville, and they ask you, will you pull down our data and just write up our financial statement? You can probably do that. It's not like you're making a decision, right? You're just taking their data, plugging it in the proper fields. But you can't even do that for public companies. Basically no loans from your clients, and if it's something that's obviously not influential to you, right? It was from before they became your client and it got sold to the client. I mean, you got that loan on the up and up, right? It was a regular car loan. You went to the dealership, you took out the car loan, and then they sold that car loan to the bank you audited. Well, okay, you weren't doing anything wrong there. But the point is, you're trying to keep from looking like that loan was a bribe. Once you and your clients get in a lawsuit, you can no longer audit them. So if you sue them because they didn't pay you, or they sue you because they didn't like the audit you did, well, you can't audit them anymore. You're not independent. Now, financial interest in a non-client may impair independence with the client, right? So if you both own something, so you own the non-client and the non-client owns the client, you can't audit them, right? So SEC and PCAOB. So all these rules, these are AICPA rules, 101. SEC and PCAOB, these are for public companies. You have to be independent, period. It's even more strict at the SEC and the PCAOB. Of course, these are all big companies. They're being audited by other big audit firms, you know. So this can become a problem with independence because these big firms, it's hard to keep track of every single partner in every single office. So non-audit services are restricted, right? You can't do any of this stuff for an audit client, which is basically everything, all right? The only thing you can really do are things like tax services that are just basic tax services. You can't even do basic tax services for the CEO or CFO or those two people. So basically, you're pretty much prohibited from doing anything except auditing a public company. All right. In order to maintain independence, the SEC requires that audit fees be reported. You have to answer to the audit committee. And anything you do has to be compatible with maintaining your independence. So basically, everything is about maintaining independence. If you have any questions about independence, I'm sure we'll be able to answer those on Monday when we have class. All CPAs have to have integrity and objectivity, not just accountants. You can't subordinate your judgment to others. So even though you go work for a company, let's say you're working as an accountant, and you're not auditing them, so you don't have to be independent. In fact, they pay your paycheck. You're very clearly not independent. But the CFO comes in and says, hey, I want you to change this on all the financial statements, and we're going to set up this reserve account, and you know it's the wrong thing to do. You can't just say, my boss told me to do it. If you're a CPA, you have to do the right thing, have integrity and objectivity all the time. In fact, if you do disagree with your boss, you have to go up higher level or consider resigning, actually. You have to always take the appropriate action. The rest of the stuff, you have to follow standards. You can only do something that you can do with due care. If you don't know how to do something, you can say, oh, I don't know how to do that. We'll have to find somebody else. Plan, supervise. You can't disclose confidential information. So insider trading, you can't do that sort of stuff. You can't tell your friends about the stuff you know from your clients. Now you can disclose things if you have to, right? So if your work papers are subpoenaed by the court, well, now you have to. If there's a quality review going on, now you have to. There's an ethics investigation, now you have to. If something is conflicting with your requirements to prepare the documents correctly, like say your CFO is telling you, I want you to do this, and you say, no, I won't, and they do it anyway, now you kind of need to blow the whistle on that. It's slightly different. I mean, you can't let people get away with a crime and say, oh, I'm being confidential. We're not going to ask you questions about contingency fees, but you know what? Auditors can't accept that. Some accountants can, but not auditors. So just here's what you need to know. This is an audit class. Auditors can't accept contingency fees. You can't do an act discreditable, which is things like not filing your taxes, harassing somebody, discrimination, right? You can't discriminate against people, lie, cheat. This is just your general catch-all. You can't do anything that would make CPAs in general look bad, and that applies to auditors and not auditors. Advertising can't be false or misleading. That applies to auditors and not auditors. Commissions and referrals, auditors, you don't get to have those. So just forget about it. No, nothing for auditors. Sometimes some tax people sometimes refer somebody to an attorney and get a little referral fee. That's okay, but not for auditors. Your name can't be misleading. So like if you were like going to name your CPA firms, Hernandez and Rodriguez CPAs, there needs to be a Hernandez and a Rodriguez who are CPAs, that kind of thing. Can't lie. We're not going to worry too much about international standards. State societies make sure, and the PCAOB and the SEC, everybody makes sure that auditors are following these rules. And what I really care about are these independence rules. Alright, so if you can make sure you understand Rule 101, right, who's covered members, Rule 101, SEC rules, you should be good. Alright, I will see you on Monday, and we will talk more about Module B, and hopefully you'll feel pretty good about ethics.